What we're waiting for now?
Yeah, I think we can start. So I would like to welcome everyone to our today's webinar on overview of insurance market conditions for educational and public sector. My name is Maria Hadra and I will be your host for today. So before we start, I would like to remind you all you have joined in a listening mode only, so please use message facility to answer and to raise any questions, which we will answer at the end of the session. And today I have two fantastic guests from AJ Gallagher. It's Mark Sangster, Executive Director for the Public Sector and Education. Mark has over 20 years experience in insurance and risk management. He's supporting a large number of public sector customers with their insurance requirements. And our second guest is Phil Webster, also Executive Director with 27 years experience within insurance and risk management, with 15 years of experience dedicated to educational sector. Both our guests are valuable speakers and contributors at the local and national levels where they share their experience and professional advice. So welcome both. Thank you for joining me today.
Thanks, Maria. Good to be here.
Thank you. So what we will do now, I will just stop sharing my screen and I will allow our guests just to take over our presentation. Okay. So I stopped sharing my screen. So, Mark, would you be able to pull your presentation, or would you like me to?
No, I will attempt to do that if you wish. As I said before, it's been a little while since we've used Zoom, and it seems to have changed a little bit. We kind of teamed a bit now, so I'm a little bit lost in terms of what I'm seeing in front of me about how to share the screen.
On the bottom, Mark, there should be there's a band along the bottom, share screen.
Oh, okay, yeah, okay. Got it. It doesn't seem to be doing anything that. It might, oh, here we go, it's just a bit of a lag. Okay. Click that and click that.
Yes, we can see it.
We can see that, good, okay. It's just the way that my system's set up, it's not particularly clear. Okay, let me just start the show then, 1 second. Right, okay. So just so I'm aware that it's happening in the background, if I press forward, that's gone forward, I take it, yeah? You can see that, Maria?
Yes.
Excellent, right, okay. Well, we'll crack on. So thank you, everybody. Sorry for the slight delay there. As I said before, Zoom's changed a little bit since we used it last, but we're good to go now. So apologies for a sluggish start. Thank you, Maria, for the opportunity for us to speak to your clients and your customers today in terms of the state of the public sector and education market. As many of you well may know, Gallagher does like to sort of work in specialist areas, and so we specifically sort of split this presentation into two distinct chunks this morning. The session should last about an hour or so. I'll take on the first part of that discussion, focusing on the specifics of the public sector insurance market. But as Maria's already referred to, we have my colleague Phil Webster, who will talk to us specifically about the education sector, because there are, nuanced differences between the current state of those particular insurance markets. So just before we kind of get into the main detail of the presentation, I'm very conscious in this new modern way of presenting in terms of webinars that some people may be seeing this after the event, or some people may even choose to go back and watch it again for those that really are struggling to sleep. But I'm conscious really that you sometimes may not necessarily look at all the sort of slides together or listen to the presentation. So we've kind of gone through the process of putting a bit more information in the slides, really, I suppose, is what I'm trying to say. So it won't be verbatim, just making sure that, you can go back after the event, or even send it on to colleagues if you feel that they would be interested in the content. So why are we here? It's not too much of an existential question so early in the morning. I've only had one cup of coffee so far. But for those that are aware, that is the thinker. So again, it's just a representation of that particular artwork. But I think it's always important when we are sort of taking the times out of our busy diaries for these types of events, which are voluminous in terms of the amount of them that are around these days, just to take a moment really to understand and appreciate why you're giving an hour of your time just to better understand the topic that you're listening to. Again, just push that theme further forward. A good quote that I've used many times, many people have seen this before in presentations I've done. An investment in knowledge pays the best interest, coming from Benjamin Franklin back in the day there. So hopefully there will be something that you will take away. It says this afternoon, a bit premature though, it is obviously still the morning time. And a reminder really that this is kind of a macro insurance conversation. So some of the things, headwinds that we've seen in the last 12 months, and one eye on the future really, and what that may pose for clients in the sectors that we're talking about. Phil will do likewise, of course, on the education sector, because as I said before, there are some nuanced differences there. So just very briefly, and again, people that have seen my presentations in the past will recognise this particular slide. It's difficult, I suppose, to squeeze 30 odd years of commercial insurance into one slide, but this pretty much is, the current sort of plotted history of the insurance market. It's always important, I believe, to understand the context. So we'll have people that come and go into our sector all the time. And sometimes it is good to remind people of where we've been and the journey that we're all on together, really, to do the best that we can for each of our respective organisations.
Sorry, Mark, to interrupt you. Can you please click again for me your slides, please? Because slideshow didn't start on my screen. Can we please double check? I still have
right, so it's not moving along.
Screen. Yes.
Hold on. Let's see. I wonder why that's happening.
Is that moved? At the top bar, you have from the beginning, it says. Just go up for me, please. Yeah, no. Yeah. It says from the beginning, the very first button. Yes, please.
Yeah.
If you click on that.
Resume slideshow.
I'm just now on a second slide now.
Okay, so that's a picture of my face.
Yes.
Okay. Let's have a look why that's not moving along then. So let's.
If you try to from the beginning, and then you can use the arrow to move your slides.
Well, that's what I was doing, which is why it's odd, really. But let me just.
Yeah, just click that one from the beginning.
That's what I've done. So, hold on. Is that not moving now?
No, not for me.
I don't know what's going on then, I'm afraid. I'm in presentation mode, and
yeah, I can see the "Why are we here" slide, Mark.
Right. Okay. It keeps on saying resume slideshow every time I change the slide, which I've not come across that before. Maybe I'll have to just change it each time along. So where I was up to was there. So can you see the current UK public sector insurance market? I've got a red line around that, so that must be showing.
Yeah.
That's good.
Okay, I think I have to double click something. That's fine. Okay, well, thanks for letting me know. Apologies everybody for that. Hopefully I've resolved that going forward. If not, please do jump in again, please, Marie and Phil.
Okay,
yeah, so as I was saying, it's an appraising, really, I suppose, of the sort of main UK public sector market. So just move on to the next slide. Has that moved across so we can see the graphic?
Yes, it has. Thank you.
Excellent. That seems to be working now. So whilst this is looking to summarise the sort of current position of the UK public sector insurance market, I think it's important to sort of characterise that it is very difficult to do that with one graphic, and of course one graphic can't illustrate a global industry as such as the insurance industry. But if we were to sort of play a game of pin the sort of arrow on the donkey, then that's probably where we would put that arrow at the moment in terms of the general insurance market for UK public sector. Maybe slightly be in different positions for different types of industries. I suppose you could argue that each industry, each country, each product line will be in a different position on that graphic. I mean, a great example would be, I suppose, D&O insurance. Going back a few years now, that was one of the first, if not the first, sector or product line to move quite aggressively in terms of availability and price. So that's probably gone around the circle a little bit further now as markets have calmed down and underwriting is returning and capacity is returning. So what are the current conditions, I suppose, really? So I think it's incumbent upon us to look back at the preceding 12 months. I mean, that in itself is the fundamental of underwriting, really. We're looking back at the past to try and get an informed view of what the future would be. I mean, I'm sure underwriters would argue there's a bit more to it than that, but I think that's, you know, fairly decent chunk in terms of looking at claims experience to see what may manifest itself in the future. So I think it's always important that we have a view of what's going on in the sort of medium and short-term past, and of course that view of what's going to happen in the future as well. So that's the 7-day forecast, and as the graphic kind of shows there, really, it's a little bit like the weather at the moment. It's a bit of a mixed bag, really. Unseasonably warm at one point and then pouring down the next, really. Quite an odd weather forecast and quite an odd market, quite handily. So in terms of some of the other sort of questions that we would sort of pose at this stage, I think most of the individuals on the webinar would be insurance people and risk people and maybe even procurement. And of course, we do have a very well-trodden route to market, which is guided in our particular sector by procurement rules and regulations, which we all follow. But yeah, it is important really to remember the fundamentals of what we're doing, which is to obviously transfer risk ultimately to an insurance company, and making sure that the partner or the organisation that you're using to do so is the right partner for you. And obviously there are, you know, different requirements at different times, but making sure, you know, that they've got that financial strength and security that you're looking for, because again, it's not unusual in our sector to see some fairly long tail claims, especially with liability, which can clearly go back decades in some cases. As we'll talk about in a second, municipal mutual still receiving new claims today, even though it's been on a scheme of arrangement for some time now. Do they understand your business and where your public sector organisation or your educational institution is moving to? Because obviously there'll be changing in expectations and statutory obligations that will evolve over time. So making sure that you're working with the correct sort of organisation. Do they support you with risk surveys? Is the claims innovation where you would like it to be? We're seeing some of the AI that's now available come into the claims handling arena. Is that something that you're comfortable with, etc., etc.? So just some fundamental questions to ask really at the right time for the insurance companies that you are looking to work with. Moving on again. Having to double click this now, but I think I've fixed it. So again, just a reminder really, why is your insurer important? So a couple of graphics there. These are two high profile failures, I suppose we'd have to call them. Hopefully that's not too controversial thing to say, but for balance, one is a public sector owned organisation, which was obviously MMI, and then we have independent insurance, which was a private sector organisation that was primarily a commercial insurer, but I think did probably dabble in a bit of public sector insurance as well. soon after MMI's demise. What happens when it goes wrong? Clearly, MMI are working very hard on a solvent scheme of arrangement, and that's been around for a while now, and may will continue for a little while further. I've put the FSCS in there, Financial Services Compensation Scheme. Again, probably for others to debate, but certainly from an insurance perspective, it does provide for compulsory insurance, the ability to pay claims from insurance companies that do become insolvent. So they don't just protect our deposits in our bank accounts, which they're probably more well known for. The remit does cover insurance as well. However, I think where it does become slightly complicated is it talks about compulsory insurance. And again, legally speaking, public sector organisations are exempt from the Employers' Liability Compulsory Act, as many will know. And again, motor insurance with the statutory instrument there. But still worthy of note, I'm sure. So just on this next graphic, in terms of some illustrations of what is happening in the market at the moment, or what could potentially happen in the next 12 months. So this is just randomly one particular very anonymous claim, but there are some big numbers to it, which I think is good to illustrate. So again, assuming we've got insurance and risk professionals on the call, I'm not necessarily going to go into the ins and outs of the discount rate. Well, I'm sure everyone is aware that it's a mechanism basically where insurers can reduce the size of compensation in injury claims based on the expected amount of interest that can be obtained, certainly from the larger payments. This kind of explains or illustrates the effect that happened last time. So we've got a fairly decent sized claim here, as you can all see. 0 days go by because there was a fairly big change to the discount rate a couple of years ago. And just on one claim, it had such a material impact on the value of that claim. It went from 13 million to 19. Obviously, it did settle down a little bit afterwards. That's just one claim, one example. If you put that across the whole insurance industry in the country, not just public sector, clearly that's going to have an effect on insurers' reserves of any shape, size, etc. The bad news for us all, I suppose, is it is due another review next year. And whilst global interest rates have risen, as we're all acutely aware of, what I think people are concerned about is that hasn't necessarily been passed to the individuals from a retail perspective. So it may be a fairly difficult discount rate change, but we'll only know that later in the new year. Hopefully it won't be as dramatic as last time, because it had been 20 odd years since it was reviewed. I think that was probably part of the problem last time. This time it's only been a couple of years, although obviously economics has changed slightly in that time. So if we sort of move a little bit now in terms of the specifics of the insurance market, so moving away from the macro events that may be feeding some of these changes. I think, despite some of the issues that we are seeing in the insurance market in the last couple of years, sat here today, we're all pretty confident that it still generates competition. Basically, we're in a situation where for the last 30 years, we've probably got more providers of risk and insurance solutions to public sector organisations than we ever have before, as it states in the second bullet point. Procurement methodology is a benefit. We're all taxpayers, and we need to make sure that our taxes are paid in the most efficient ways, of course, because there's lots of competing priorities for those funds, as we know about. But it can be a burden from a bureaucracy perspective, and also, bringing in new entrants. Sometimes it can be seen as a bit of a blocker. But obviously, we constantly talk to insurers on a regular basis about helping them through those processes, as I'm sure other brokers in the sector do as well. I think one of the sort of big changes in the last couple of years really is that we do have a market that's dominated by two particular insurers, which we'll come on to in a second. that they're no longer all things to all risks, which I think is a bit of a change in the last few years. Doesn't mean they're not still hugely significant in the market, of course, but we don't go through the hard market cycle we go through without having a few scars left. And I think that's an important thing to remember about market changes, is that it isn't bad one day and good the following day. There is a period, intervening period between the two, and sometimes there are some sort of changes that are left beyond the actual trading period. It essentially means that they are a little bit more selective than maybe they had been in the past. In terms of the mutuals, of course, any discussion of public sector insurance has to touch upon mutuals and where we are with that. I can't really comment too much about the ins and outs of it. That's for those individuals involved in it. But as far as we're aware, it struggled to get off the ground in its current guise. It may well come back in some capacity in the future. It's obviously for them to decide either that same entity or
I think we lost Mark. Mark, are you there?
Yeah, I'm still here. Can you hear me?
Yes.
Yeah, we lost your camera, Mark.
Yes.
Right. It's going well, this, isn't it? I'm not too sure what else could go wrong. My lights come back on, so I think hopefully you can see me again.
Yes, we can see you, but we can't see your presentation anymore. I think you have to re-upload it.
Right. Okay. Let me just close that down then and start again. Oh dear. Is that back on?
Not yet.
Don't know what's going on today. All sorts of gremlins.
Right, would you like me to navigate the slides?
If you don't mind, I mean, I don't know why it's gone off.
Bear with me for a second.
Conscious I'm going to be eating into your time as well, Phil, really, the way we're going.
Well, that's no problem.
Do you want to bring them up then, please, Maria?
Yes, I'm just uploading them on the screen now. Okay, let me just share my screen. Right, can you see my screen?
Yeah.
Yeah, so let me just move to
If you just go
mutual.
to the ZM slide, I think, please.
I think it could show off a mutual. Right.
Okay.
Yeah, so we're now on ZM. Yes, you're right. Sorry.
Right. So I don't know what people missed of that in terms of the mutual, but I was probably just saying that it tried, and it's, as far as we're aware, not actively engaged in any activity, but may well come back in the future. Right. So what we'll do now, before the computer completely collapses on itself, or I have some sort of aneurysm, is we'll just talk about some of the main insurers in the sector and just give you a quick update in terms of where they are and what sort of driving those particular insurers at this particular time. So as you would expect, Zurich have been around since year dot and remain the largest public sector insurer in the market and extremely important to the sector, dealing direct with its customers. It has had a few bumps in the road in terms of some of the areas of property, and there has been a couple of business reviews, I think, in terms of the sectors and the areas that they wish to work within. Notably some of the HEI stuff, which I'm sure Phil will talk about, but more recently leasehold and some of the sort of niche areas of NHS fleet. They have decided to exit from in recent times. Some of the sort of long-term customers being re-underwritten. So again, risks being looked at in a bit more detail, and you know, in rare cases, changing of a status in terms of ZM's involvement, etc. That does happen with all insurers from time to time, of course. I think where we've also seen changes is a focus on some of the terms and conditions, maybe some of the deductibles, the cover that they're willing to offer, and a re-emphasis on risk improvement programs. Again, that concept is not new, but there's certainly a renewed vigour in making sure that risk improvements are looked at and complied with in a timely fashion. Motor and liability does seem to be a little bit more sedate for them. I think, you know, where they may have had some change in view of the world is on property, as mentioned. You want to turn the next page, please, Maria? So RMP are you know, an extremely important market as well to us in the public sector. They've gone through a difficult couple of years, really, in terms of increases for their supporting insurers, those mainly being AIG and QBE, but obviously they do work with other names as well. Just didn't all fit on the screen. That there has been insurer support for RMP based on increases, as mentioned. Of course, changes in renewal don't just focus on price, but T's and C's and risk management, akin to what we were talking about in terms of ZM previously. There is a belief that the rest of the market has caught up with RMP in terms of rate increases. So I think they were, you know, pretty much first out the block with some of that, and things have calmed down. There is sometimes a package bidding methodology, although that I would say you've not seen as much of that now. I think again, there is a bit more selectiveness on some risks, a bit similar to what we talked about with ZM. But yeah, really important market, and certainly open for business as they all are. If we move on now to Protector, please. Very data and risk-driven insurer, maybe even more so than some of their competitors. There can be a bit of a sort of a hot or cold approach sometimes. They really want something or they don't want something. They don't find them in the middle ground all that often. I think they've kind of reinvented themselves slightly and moved into the housing sector quite aggressively of late. Particularly leasehold, which has been vacated by ZM, not just ZM, of course, other insurers in that space as well, maybe less well known than ZM, but certainly there's been a change in that market of late, and Protector have been very successful in that area. You know, they've not been around in the UK for a huge amount of time, 7 or 8 years, I'm sure, around about that time. In that period, they've become the third largest public sector market. So, you know, really got to grips with it quickly and have been successful in that period. Still a new company in that sense, still learning. Don't have some of the sort of legacy issues, I suppose, that you would see from the likes of RMP and ZM. But really important that they entered the sector a few years ago and have made a big difference. There are, you know, quite a few comings and goings, primarily just because of the demographics of their workforce in public sector. But you know, the main sort of management of that public sector team remains consistent, and you know, they're open for business, as I say, the other insurers are. So just moving on quickly, just conscious of time. Travellers is the next insurer. I think without any doubt, property is their sweet spot at the moment. They can be quite aggressive on the risks that they like, but again, completely legitimate to do so at the right time is to pre-engage with travellers, so they can start to understand the risk a little bit and maybe even do some modelling. They will write motor, but I find, or we find of late, that the motor has sort of waned a little bit of in the last couple of years, but certainly property is where they're looking. They are a small team because obviously they're not writing some of the heavier classes of business. Still, as far as we're concerned, declining upper tier liability and blue light, which they used to do once upon a time. They may well return to it one day. Hopefully they will, but not just at this stage. Then if we just move on to Maven. So Maven, a little bit similar to Protector, been around now for 7 or 8 years. MGA with the support in the main of AXA XL and Aviva. There are other names involved, but that just the main two. Really worked hard to keep pricing stable through a very difficult period in terms of hard market conditions. So credit for them in that regard. I think we're seeing their motor and liability part of their strongest proposition at the moment. Property still needs a little bit of refinement, but doesn't mean that they can't write that and be successful at it. I think of late they've concentrated on improving the resources, which again has not been very easy for many organisations, and they're stronger than ever in terms of the number of people, which has had a really positive impact on the servicing as well. They're really important second market to us as well for police clients, which has struggled over the years. Do write a number of police cases already, and we look to do more. Just move on. So just wrapping up in terms of some of the other participants. Some of you may well have heard of Edison Motor in the past. They were backed by Berkshire Hathaway. That came to an end, I think, towards the end of last year. There has been a period where they've not been open for new risks, but we believe they're now a Lloyd's syndicate with the backing of their parent and are writing risks from the 1st of October. So another motor carrier for our public sector. They also do write blue light risks even, which again, for the reason mentioned before, is important. We've got insurers like Swiss Re, which may not necessarily do what we call traditional insurance, but will write parametric. So these are events like flood, where it wouldn't necessarily pay out because there has been a flood, but if the flood reaches a certain level that's been pre-agreed, then a payment would be made. I mean, I'm really undersimplifying it there, oversimplifying, I should say. But that's essentially what they would write, and maybe something that some insurers and clients would be interested in looking at in the future. A couple of other insurers mentioned there as well. We've continued to engage. It's part of a broker's role to bring competition. It can be difficult in our sector for various reasons, but we've seen Protector join it. We've seen Maven join it, as mentioned, and we continue to talk to other insurers who may well get on board as time goes by. And certainly we've seen some success on that, stealing a bit of Phil's thunder. Next one, please. Blue light risks. I'm not necessarily going to dwell on this too much because of time, but it does continue to be in distress, especially motor. There have been a number of high-profile claims. It's a limited market in terms of insurers, although we have just seen Edison rejoin it, as I mentioned a moment ago. So hopefully we will see some benefits of that. Risk management is very, very key in these risks, of course. And essentially trying to stop claims from happening in its most basic form. And all those clients are aware of that and working hard to improve their risks, improve their claims, and hopefully bring a bit more stability to the market, because it can be quite tough at times. Next one, please. Yeah, I'm going to skip through these next two slides. So I'm aware we've only got 20 odd minutes left. Really, it's not fair on Phil. So I'm not going to talk about alternative risk transfer, apart from the fact that we know it exists, and in some circumstances and with some client types, it could be something that would be worth looking at. And I know, again, stealing Phil's thunder a little bit, that is making some traction in the education sector. We've talked about it in the public sector, but it hasn't necessarily sparked, but maybe one day it will. And then future challenges. I'm really going to stop at this stage. I think this is just a list of things that we feel will be challenging to our clients in the future. None of this is stuff that isn't known about already. It's just a continuation. Things may improve or get worse. I think it's important that we recognise those things, like climate change and cybersecurity. There's a bit of detail there about what we think will happen in the future. There's obviously further examples of that. There's only so much we can put on the page. And again, on the next slide, some of the future challenges that you face really as public sector entities. So again, the ever increasing budget constraints, the risk profiles that you've got, which continue to evolve, of course, seem to get worse and not improve, despite best efforts. You've always been expected to do more, and the sort of nature of these things to evolve quite quickly. And then things like public perception and accountability. So we see that in the news on a regular basis. So in summary, we just go on to the last slide. Despite its challenges in the sector, it's still working and working well in many regards. It's all driven by claims, of course. No matter how good you are in terms of an organisation with risk management, and you've got the best broker or the best insurer or the best risk manager, all of those things are important, but it's about the claims and to sort of have a compelling story in terms of claims. It's not about having claims. You can have claims, they're expected. It's just really knowing those claims and making sure that you've got a story to tell in terms of how those claims will be managed and not happening similar again in the future, of course. All in the chain, insurers, risk managers, brokers, procurement, everybody involved are working harder and harder to get the results, but good results are still available. It's just more effort is needed for everybody involved to get over the line and to have a successful tender. But essentially, that's the main message, really. So on that note, I will stop talking. Hopefully the computer's still working and people have been able to hear most of it, and I'll pass over to Phil.
Thank you.
Thanks, Mark. For those of a certain vintage, I'm tempted to reference Morecambe and Wise show and say, what do you think of it so far?
Thanks, Phil.
But morning, everyone. And we've got about sort of 20 minutes left. So I think I'll probably sort of try and take you through the rest of the hour. I don't think we've had any questions come in yet, but obviously very happy to take any that do come in. Again, thank you to Maria and the team at YPO for allowing us this opportunity just to sort of chat through where we are. As Mark has referenced, I'm going to focus on the education market. We've sort of, as best possible, to ensure there isn't too much repetition across the two pieces. Inevitably, there will be because such are the common themes. I've tried to highlight what I believe are the key issues for the education sector on their insurance purchases, which are kind of firstly tackled strategically and then in relation to the individual classes. So, Maria, I don't know if you can sort of take us to the first slide, which is around the market cycle. It's a slightly different graphic from the one Mark used, actually. And I think it's interesting because it's more of a linear pattern. And I think my observation and comment is that if this was a typical and historic market cycle, we'd normally be expecting a return to softer market conditions probably in the next 12 to 18 months. But there are some barriers here, though, and not least the length of time of the previous soft market, which provided for sort of benign rate conditions broadly for around sort of 15 years, maybe a little bit longer, actually. Excuse me. Add to that the inflationary environment, and I think that complicates the picture further. And where we see rates plateauing, I think a prudent buyer keeping up with accurate property valuations will see increases, even with flat minor rate reduction environment. There is more positive news, I think, with the high interest rates ultimately, and that should support excuse me, insurers' investment returns, which historically have supported rate reductions. So I think overall, if I was a weatherman, I'll be saying this is a bit of a mixed picture. And overall, I think it leads to a difficult call to make on the future rates. And so whilst this graph is showing a downward curve going forward, which we would concur with and I think encourage, I think the extent and the length of this is going to be hard to call. So if we can focus therefore on some of the emerging themes to help us decipher the market a little bit further, Maria, if we can sort of take it onto the slide on inflation. As Mark has already referenced, inflation continues to play a really quite significant role both in insurance premiums and the attaching cover. And the key question for you as buyers is what does this mean for me? Well, what I would point you towards is a couple of factors in relation to that. I think the most obvious is obviously in ensuring you're building some insured is accurate and up to date. And the best way of ensuring that is obtaining an up-to-date RICS approved valuation survey. Where there is any element of heritage, and we know there is a number across, particularly education sector, can be across public sector too, that needs to be factored in as costs, and replacement times here are escalating considerably. A good valuation will build in the costs around your heritage element. Think also around your reinstatement time though. While most of our PSC and certainly education clients will probably have a 60-month indemnity period, that may well need to be expanded for specific heritage properties to factor in sourcing rare materials, potential interventions from conservation bodies and the like. We don't think it's going to be too long before pressure will be exerted on liability rates too, because of the inflationary environment too. Currently, liability underwriters are being protected by increases in wages from salary settlements across the public and education sector. As those begin to plateau, though, I think the legacy ultimately will be increased legal defence costs passed on from our friends in the legal community for their own wage costs. So I think whilst liability rates have been benign, I think it's prudent to keep a watching brief on that. If we can move the slide on, Maria, thank you. What I wanted to touch upon now is what I'm sort of referring to as disaggregation. And I think it's one of the major themes I want to sort of draw out of discussions today. The education sector in particular has seen a moving away from traditional providers. And over the page, Maria, we document those kind of providers. And I'm not going to go over the ground for their reasons for, some of their either withdrawal or some of their reduction in underwriting appetite. But suffice to say, these providers broadly have been kind of one-stop shop approach, and they have become more selective of the classes that they offer. Excuse me. And that's given rise to entrance into the education sector and to a certain degree public sector of commercial corporate providers moving into this space. As the rates have increased, they've said, actually, I think there's a role for us to play here. So over the slide, Maria, I think we've detailed some of these newer providers that we're beginning to see. Is that the new slide?
Yes.
Okay. So those are the more traditional providers. If we can move it on again, we'll take it on to the sort of some of the newer providers. Thank you. Now these providers are quite selective. And they'll also be selective within the classes of insurance that they write. And this is sort of seen in our ongoing discussions where underwriters want to target, for example, small and medium-sized property exposures. The ones from an HE perspective or an education perspective that don't have extensive research and development facilities or heritage elements. Equally, we have some that want to target those. Because the expectation is that on those larger ones, the self-insurance is going to be higher. The excess deductible programs are going to be a little bit more evolved, and they'll gravitate towards those. And it's not just in property that we're seeing this either. I think we're beginning to see financial lines markets that, for example, are focused on management liability and D&O and crime, but not PI. But then those who actually gravitate towards the larger, more complex PI programs, again, because of the high level of self-insurance these attract, or that they're comfortable with the activities that they're undertaking as they align more to the segments that they write elsewhere, like pharmaceutical or biotech type risks. So again, the question that I would pose is, what does this mean for you as buyers? Well, hopefully more entrants will lead to more competition. I think disaggregation means that the education sector is beginning to follow more traditional commercial buyers. And any buyer of a commercial insurance program will tell you there's not a single insurer that provides all the cover. It would be too much of a coincidence that you've got one insurer that's the best at everything. I think it also does mean a continued focus on declaring your activities so you can be best matched to your insurer. And again, following on from discussions we've had within the sector and within the industry around duty of fair presentation, I think we're beginning to see now some further focus around you need to be really clear to underwriters about what your activities are, what your risk profile is, and where you sit within your sector. So as I said, you can be best matched to the insurer that wants to target your business. Now, I would say this, and I guess a lot of you might think, well, he would say this, wouldn't he? But I think it does also give a focus on the broker or consultant advising on the program structure. It's really important with commercial insurers who are a lot more black and white on cover interpretation and on the classes that they provide. I mean, this wouldn't be news to any commercial broker, but I think it does provide an emphasis which we recognise around understanding your operations and your future plans, declaring those, and dovetailing together the different classes of insurance that you have. And also, I would reference YPO here in terms of their DPS arrangement for their insurers, where what you're beginning to see is insurers enter onto a DPS arrangement for specific classes of insurance. And again, I think that's we've seen the evolution on some of the frameworks like YPO, and we would really encourage that because you're beginning to get specialist insurers coming into the sectors who want to target, certain classes of insurance. Our job as broker is to identify what the advantages of those are, firstly, and then secondly, how that knits together with the rest of your program. So, Maria, if you could just sort of take us forward onto the next slide. Thank you. I want to touch now, we've touched upon some of the strategic elements, inflation, disaggregation. I want to touch upon some of the specifics on the classes of insurance. Again, a little bit of crossover here with what Mark was saying, but I'll just reiterate some of the points. From a property perspective, I think what we're beginning to see now is an evolution of the scheduled programs. And again, the insurers that came into the space 2 or 3 years ago were looking to do this on a scheduled program. And that does remain very much in vogue. I think there is a reluctance for many markets to write on a 100% basis. Even insurers that are sort of fronting 100%, there probably might be a quota share arrangement that sits behind that. And follow markets, this is where we're beginning to see it become interesting. We probably had 2 or 3 within the education sector that were prepared to do lead lines on a scheduled program. We're beginning to see now some of the follow markets that followed those lead lines step out and say, actually, we could potentially do some lead lines. So the competition for the lead lines on scheduled programs is escalating, and we expect that to continue into 2024. Excesses, I think, again, probably minimum from an HE perspective, probably at 10,000, up to probably maximum 100,000. But again, we're seeing some sophistication develop around those. Capacity does remain an issue, and I think that's really important. And I think the loss limits piece is really relevant. Again, what we would say from a property perspective, a big focus upon understanding your EML, your estimated maximum loss across your estate. And we would really encourage EML surveys. Our philosophy is around what we call portability of risk. So ability for you to move your program between different insurers. And you need to have the intellectual property that you own to be able to do that and approach different markets. EML is really crucial so an underwriter can understand what capacity they need to deploy to be able to meet your expectations. Absolutely critical, EML surveys, and being able to give that understanding to insurers. I'll move on to the next slide, please, Maria, just around liability. So again, I've referenced the plateau in rates, and against an inflationary environment, competition does remain strong, and I think there is a desire from providers to retain cases. I think we're beginning to see quite a lot of focus, though, around duty of care and universities' duty of care, and there are concerns being expressed by underwriters about some of the more high-profile legal cases that have come out recently, and that could potentially impact rates. It could impact appetite. It could drive amendments in cover. So it's really important that we maintain a watching brief on that. And again, just aligned to that, I think what we're beginning to see is insurers build into their proposition not just risk transfer cover, but sort of well-being support aspects, because this is about being proactive on your risk management. And insurers are beginning to sort of offer aspects around counselling, and other methods of support to students and staff, particularly around mental health, to complement their proposition, which we would really encourage. It's then incumbent upon you to build that into your evaluation criteria as buyers around how important that's going to be alongside cost and cover. Final slide, I think, on the classes of insurance, please, Maria, around the financial lines. As I referenced earlier, I think we're seeing some new providers, which is really encouraging. But again, they're sort of being really focused as to the classes of insurance they want to do. But PI does remain a problematic class of insurance, I think, for the education sector because of failure to educate type claims, but also increase in disability discrimination type claims. So I think we're beginning to see some competition around crime, management liability, new markets emerging there. But I think there are some complexities still around PI. Encouragingly, on management liability, we're beginning to see corporate legal liability being offered now. It's usually lower than the standard policy limits, but it is a really important element of cover. And we would really encourage you to consider building that into your specifications to see how insurers can offer that. Again, though, there is some sort of dark clouds on the horizon. There is sort of some litigation being brought against universities in relation to both COVID and industrial action. That's still playing out. And I think there are still some concerns as to what that will mean. So my final slides is on ART2. And I think my comment there is around, as we're seeing this evolution on commercial programs, and we're seeing a more sophisticated type risk transfer arrangements, the conversation will inevitably move to ART. I think as well, because of emerging risks, and I think we're living now in an environment where there are questions, how relevant is your insurance program to the actual risks you have on the ground? You know, your traditional insurance program protecting your buildings, your assets, your liability, you know, some balance sheet protection on your financial through your financial lines covers, motor. How relevant is that? And you know, obviously, we haven't really touched upon cyber here, but the cyber market is really moving at a pace, and because it is a relatively immature class of insurance, I think the general sort of feedback from our brokers is that the market cycle is just so much quicker than it would be for more traditional lines of insurance. So they've got into a very sort of hard market and now coming out at a pace into a much softer market. So I think, you know, there is a question. I attended an event a few weeks ago and there was a CEO of a major insurer who said, today, more than ever, we need new partnerships to address risks that sometimes go beyond traditional protection mechanisms. And I think what he's referencing there is, you know, how good are we being at challenging the relevance of our insurance program against the risks of our organizations? And that's a challenge for us as brokers too, that we're having those conversations with you as buyers. It's an existential question, but it's a really important one. I was always taught risk management and insurance is about protecting the sources of value within an organization. So I think the question I'd kind of leave you with is, what are the sources of value in your institution? Is it your students, your staff, your buildings and your facilities, your IT infrastructure, your reputation? How much does your insurance cover support protection of these? So that's my kind of final challenge for you in this seminar. So I think with that, I think we'll probably look to draw things to a close. Again, thank you to Maria and the team at YPO for putting this event on. I'm recognizing that a lot of people will be listening back to this recording. If you've got any questions for us, happy to answer those. And Maria will have mine and Mark's contact details if you want to have any questions around that. Maria.
Yes, so thank you both for this session. I believe our customers found it very useful. We didn't get any questions during the session, but again, you're absolutely right. We will share your presentation with a wider audience, if you don't mind. And I would like to ask all our customers to email insurance@ypo.co.uk. Like Phil mentioned, we can put you in touch with AJ Gallagher's and they will be able to answer any questions you might have. So I'm concerned about time. We have just 3 minutes left. So just again, I would like to say thank you. And I think we will just wrap up here, if you don't mind.
No, that's fine. The only thing I would quickly add, I should have mentioned it before, but the IT got on top of me, is that we've recently produced our State of the Market bulletin as well, which sort of goes alongside the presentation today. It talks a little bit more about the product line, so talk specifically about property, liability, motor, etc., more than maybe some of the insurers, which we talked about earlier on. That's available to any client or contact we have. If you've not got it in your inbox already, it will be available via our social media channels as well. So please reach out and get that if you so wish.
Brilliant. Thank you so much. So thank you again for your time. Really appreciate it.
No problem at all. Thanks, Miriam. Thanks all.
Thanks
Thank
for the invite. See you soon. Bye-bye.
Thank you. Bye.